This is Michigan's retirement coach, Mike Douglas.
I'm Heather Branch here with Mike to talk about things you can be working on in an effort to better prepare for your financial future. LifePlanWealth.com is where you can go to begin your conversation with Mike and his team. We also have links posted in the show notes, so you can just click there if that is more convenient for you. Or again, visit us anytime at LifePlanWealth.com. Mr. Douglas.
That's LifePlanWealth.com.
Oh, I'm sorry. I forgot about the emphatic pause.
Nice long pause for dramatic effect. LifePlanWealth.com.
Okay, got it. Well said, sir. I don't have to explain
it's been a good show for me. Thanks. It's a wrap. Appreciate it. I've brought my contribution today.
As I was saying, I don't have to explain to you all the noise that is out there in this world. Speaking of noise that you bring.
Yes, there's a lot of noise.
So much noise. Also a lot of good information. It's always a little bit unnerving when you hear some things from people that you maybe even listen to. And you're like, wait a minute, hold on. This is a person that I think is a good person. And now you're saying these things and everybody needs to take a pause. This is exactly the case scenario we're in with Mr. Dave Ramsey and the recent declaration that he has made on his radio program. So Dave Ramsey, popular nationally syndicated personal finance radio host. So you've likely heard his radio show. You probably know the face, the name, maybe has read his books because he has a lot of great insight. And anybody that's going to encourage anybody to get out of debt, you get a thumbs up from me. Like, yes. Mm-hmm. And that stuff is good and right information. However, recently he has said some things that have my flags raised. And this is what I wanted to talk to you about today. He recently said that retirees should remain 100% invested in stocks. They should stay this way their entire lifetime, and then go ahead and plan to withdraw 8% of their portfolio per year, and they should be able to do all of this without worry. 8%. Financial author David McKnight, he is saying that Ramsey is basing all of this on unrealistic annual market returns of nearly 12% and also is not considering volatility. So here is what David McKnight was saying.
In other words, just because you average 11.8% per year, if that's even possible, doesn't mean that you'll be getting precisely that result each and every year. And as it turns out, the order in which you experience returns in retirement is one of the biggest keys in determining whether your retirement assets will last through life expectancy. This is why economists and financial experts in academia are so opposed to willy-nilly haphazard approaches to sustainable distribution rates in retirement, because unduly high withdrawal rates can easily bankrupt you years in advance of life expectancy, and at that point you'll have to eke out an existence subsisting on Social Security alone.
Social Security alone is obviously not a good income plan for anybody. Mr. McKnight had a lot of thoughts to share there in a 30-second span of time, Mike.
Yeah.
The thing about there are several ways to look at this because one, should anybody be 100% invested in stocks their entire lifetime and assume that you're going to get 12% returns annually? When we have had conversations talking about the 4% rule, that's the idea of you can withdraw 4% in retirement. That's based on theories from the 90s. They're saying that might be a risky plan at this point. So Mr. Ramsey is saying 8% pull is okay. How do you see all of these things?
So I agree with you that some advice, my father-in-law uses a phrase all the time that you have to eat the hay and spit out the sticks, right? There's good content out there. Mm-hmm. Just because someone says something crazy doesn't mean that a lot of what they said is not right. It's just a matter of the crazy thing. You got to go, that's stupid. We're not going to do that. Dave Ramsey is very good at helping people who can't balance their budget, at newlyweds, new homeowners, people who are trying to develop and establish themselves in life and figure out some basic principles, especially if they weren't taught that as children, how to live a successful financial life.
Right.
That cannot be disputed. Is it complicated? Is it kind of a painstaking process to take your cash, put it in envelopes, and then only do that? Yes, it requires extreme levels of self-discipline. And that's what he's calling for in that space. It's very, very good. That's the hay. Or we're going to spit out the sticks with us. That's the hay. We're going to keep that part. The bad part is now you're talking about not a generic stance of pay down debt, save money. That's a generic stance. When you're telling an individual how to take money out of their accounts in retirement, on a national televised thing as a broad spectrum prescription for their finances. Mm-hmm. That's dangerous. And in this situation, I believe he's very wrong. So what I believe is that as you get to the end, because you also have to calculate on how did they save the money. If they withdraw 8% of their Roth IRA versus a trust account versus a traditional IRA, different tax consequences. If they take out too much of their money, will it cause their Social Security to be taxable? He didn't talk about that. If they take out too much money, will it cause their Medicare premiums to go up? He didn't talk about that. There's a lot of stuff he didn't cover in there. That's the one element, is that to give any recommendation to a specific individual about a specific strategy on a nationally televised thing is a bad idea. In the same way, I can't imagine just going on saying, I've got a pain in my leg and something's been hurting. And I go listen to some nationally televised show and they give something. I say, oh, that must be what happens to me. No, I'd still go to a specific doctor, have someone look at me, run tests, do reports, and come back with an actual answer. That's what needs to happen with your real health, and the same with your financial health. As you get to that phase of life, it's very specific. So we can't take this generic prescription. That's the one element. On the financial side, I believe it's deeply inaccurate also. And here's why. There's something called sequence of returns risk. Sequence of returns risk says that sometimes the market's good and sometimes the market's bad. Where do you fall on that scale when you take money out of your accounts will determine whether it works well for you, it works poorly for you. Here's an example. If you retired in 2000, so now your first retirement year is 2001, and you use Dave Ramsey's rule, 8%. That's astronomically high, by the way. The rule of 4% is in question. People are saying 3.5% is more accurate.
Right.
8%. So you retire and you have $1 million. So that means I can take out $80,000 a year. That's pretty good. That year, the market dropped over 10%. So your million goes down to 900,000, not from your distribution because the market dropped.
Right.
And you're taking 80,000 out. So now I have $820,000 left after 1 year. So even though maybe the market only dips 10%, you're down 18. Well, now I have $820,000. If I want to take 8% of that, that's around $65,000, $66,000, right around there.
Yeah.
So I either have to take a $15,000 pay cut by this rule, or I have to take out 80,000 of 820,000, which is more like 10%. What's interesting is 2002, the market lost again for a second year in a row.
Right.
And then it lost again in 2003.
Right.
So for that 3-year stretch, the market dropped for 3 straight years, a total of 43% on the S&P. And if you're 100% in stocks, that's kind of what you're doing.
Right.
You're rolling with the stock market, because one of his big recommendations is get an S&P 500 mutual fund. It's going to get you 10 to 12% and you should be fine. If you retired in 2000 for 3 straight years, over the course of those 3 years, your S&P fund lost you 43%. And along the way, you were drawing 8%, and then either 8% of a depreciated asset or a lowered asset, or you're drawing 10% to keep the same lifestyle.
Yeah. And
then it drops again, and so now I have to take out 12 to 14% or take a much lower paycheck.
Right.
You're 3 years into retirement, and you're sitting at around $450,000 off of your million.
Panic.
That's a sequence of returns risk. The other end of the scale is this. You retired in March 2nd of 2009.
Yeah.
And why do we say March 2nd? Because that was the bottom day of the stock market crash of 2008.
Okay.
Well, that year, the market went up 29%. So I had $1 million. It went up to $1.29 million. I take 8%. I'm getting like $96,000 to $100,000 of income off that money. The next year, the market was good. The next year after that, it was flat. But over the course of the last 12 to 13 years, really from 2009 all the way through 2021, the market was really good. And you think that this is the best strategy ever. Well, most economists say that the 2009 to 2021 run it's not debated. It's historically one of the best runs in history. It's an exponential growth curve in the stock market that everybody says we are extremely unlikely to see again in the next 20 years. So to take that perspective and say that the last 12 years is how we should build a model, that's dumb. You don't know history, you're doomed to repeat it. We need to understand the different timelines, because the stock market, while it does trend upward, it trends upward in kind of a sinus rhythm where it goes up, then it comes down. It's got this seasonality and cyclical nature to it.
Mm-hmm.
And if you do that and you do it the wrong time, it's just a matter of not that you did something wrong. You retired in 2000 after the market was just a boon market. It was crushing it for the 80s and 90s. You could throw a dart at a dartboard, get an S&P mutual fund and make 12, 13%, no problem.
Yeah.
And then you retire and the dot-com bubble bursts. or the tech crash of 2022, or the COVID crash of 2020, or in 2018, when we had a 10% drop in February, 10% drop in March, a recovery, and then a 19.6% drop from October 5th to Christmas Eve. There are these movements in the market that will freak you out, and it will actually have an issue on your income if you are just leaving it to chance in the market. If you're 40, take Dave's advice. Pay down your debt. Get in the stock market, pay yourself first, do all the things you're supposed to do, because that will give you millions when you retire. When you retire, don't take this advice. Sit down with a professional. Don't take a generic nationwide program prescription. Get very specific. Sit down with someone who is helping you with your taxes, helping you with your strategies, helping you with your investments to say, I know that this is what they're saying on the news. I know this is what they're saying in New York, Chicago, wherever you are, but here in Michigan, here in Wisconsin, here, wherever you are, here's what we do here. And here's how we make sure that your life lasts the right way and that your money lasts longer than you do, to create a legacy element. That is how you build a successful plan. You can't use these bad prescriptions off of a radio show. Yeah. That's the bottom line. Yeah. So when you figure those things out, you have to understand, again, eat the hay, spit out the sticks. We tell people as we sit down and we go through these journeys with people, the story of the rest of their life is the result of the backstory that got them here. They've been through 2008. They've been through the 2001, 2, and 3 crash. So they don't want to lose all their money because the market drops. So then to be told by someone, just trust the market blindly and take out a huge distribution rate, that's not a comfortable conversation for people. And that's why so many people are coming out against this thing. But it all begins with conversations. And as you mentioned earlier, our website's lifeplanwealth.com. There's a button on there that says start your retirement roadmap today. We sit down, we have these conversations about where do you want to go? And just like a GPS, when you get in the car in your GPS, you put the destination in first. Here's where we want to go. Here's what we want life to look like. And then once you do that, it gives you a map that says, here's everything you should do, everything you need to avoid. Here's the potential hazards down the road. That's what a retirement plan looks like versus a radio show throwing out some stats based on his own portfolio. This is what it looks like for individuals. Have those conversations, lifeplanwealth.com. Click on the button that says start your retirement roadmap today. We'll talk about it, but figure out what makes the most sense for you.
And I think that one point that you and I constantly try to reiterate here is the idea of individualization and how it has to be specific to you, your goals. Don't accept blanket advice. If you hear something that you think sounds interesting, that's great, but bring it to the person that you're working with on your specific plan, your specific savings, your specific goals. Mike and his team are here to help be those people to work with you on an individual level and corral all the information that you have gathered into a plan that works for you and your goals. Again, lifeplanwealth.com is where you can find us. We have links posted in the show notes, so you can just click there as well to begin your conversation. Or find us anytime, lifeplanwealth.com.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit lifeplanwealth.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.